What's happening, everyone? Welcome back if you've been following the journey, and if you're new here, this is my dividend growth portfolio. So the portfolio that you can see consists of 50-ish dividend paying stocks. These stocks collectively between all of them pay me a dividend payment probably every week. The money gets paid into this brokerage account, and then I basically reinvest the payments back into stocks which I have currently that I believe are good value at that moment in time. So with that, reinvesting the income that I receive back from these companies in turn creates a compounding effect, which over time hopefully will just snowball and grow and grow and grow. So that's part of the strategy that I'm using, and it's quite popular within the dividend investing community, and it's caught my attention and got me so interested in this strategy and the prospect of living passively without having to actively work. So the money that you see in the portfolio is very liquid, so I could actually sell out of all the stocks next week and withdraw the money back into my bank account, and it would probably take about 5 days or so, or a week, and I'd have that money in my bank account. So that assurance is quite good. Most brokerages will work in the same kind of way, that are big anyway. So currently at the moment the portfolio is generating around about £240 in passive income a year, so let's say £20 a month, which when you look at it, £240 a year doesn't sound like a lot, but if you look at it as £20 a month and think, well, what could that cover in my life at the moment? So what expense could that cover? And for me, that could cover potentially my phone bill. So when you think of it in a way that, okay, if I was to stop funding this portfolio today and use the dividend income to cover an expense, it could actually cover my phone bill. So from here onwards, I wouldn't have to pay for my phone bill, which is quite a big thing, really. So I feel like setting those kind of milestones are important, because it's going to be a long journey. You have to be in this kind of thing for multiple years. We're talking 10 years, possibly 15 years, 20 years, 30 years. Having milestones help along the way. So the goal is to ultimately build up my positions in all of these dividend paying companies, increase the cash flow that's coming into the account, and reinvest all of that cash and create a compounding effect. And over time, that cash flow that's coming into the account hopefully will be high enough that I wouldn't have to actively work anymore, as it could cover my general expenses. And most of these stocks in the portfolio, the plan is really to hold on to the stocks forever and just receive the dividend income, and you don't have the stress then of thinking, oh, when's the right time to buy or sell a stock. If you're in it for the long term, then you don't have to think about whether you're holding on to a stock for too long. You can receive that dividend income and relax. And if you're not sure what a dividend is or how to find a decent dividend stock, then you can check out the earlier videos in the channel, which explain a little bit more in depth what a dividend is and finding a good dividend company. So for me personally, I'd love to be able to retire in 10 to 12 years and live off the dividend income. However, for me to do that, I've noticed that I will need to increase my actual portfolio yield, which is sitting a little bit too low. So it's sitting at around about 3.5%, and over 10 to 12 years I'm going to need it to be averaging a little bit higher to start with. So that's what the goal was, basically to find some higher yielding dividend stocks that are at decent value right now, and increase my position. So my allocation in the portfolio is more weighted towards those higher dividend paying stocks so that I can get increased cash flow into the portfolio to compound a bit quicker. So that's what we've done this week, guys, looking at which stocks are value, 2 US stocks, 4 UK stocks. We have reinvested into 1 out of those 6 stocks is a new stock to the portfolio, so we'll get into that right now. So if we head over to Simply Wall Street, I've input all the stocks here into their portfolio. We can see that we're averaging around about 3.53%. That's how much we're yielding across all of the stocks. So we can see the highest dividend paying companies down to the lowest, and we're just a little bit too heavy on the lower side here. So we need to add a little bit more of the higher yielding stocks, add some more weight to those stocks. So ideally we're aiming for around about 4%, 4.5%. That's what we're trying to do. So as the market has dropped a little bit this week, it's given us some good opportunities to find some value in those higher yielding stocks. So the first of the 2 US high dividend paying companies we went for this week is AT&T. So we held a position with them already in a portfolio, and then being down recently has given us a nice opportunity to buy some more and get our average down. At the same time, with that, it increases our overall yield, which we're aiming for. So currently they're yielding around about 7%. That will help bring our overall portfolio yield up. Over the next few weeks or so, I'll be adding a little bit more to this position. Will help get our portfolio yield up higher. And the second US stock that we bought this week is AbbVie. So AbbVie have got a strong dividend history, pay a great yield as well. Been waiting for them to drop down a little bit, and just thought that I'll get in this week as it's dropped down, help get our average on this stock down as well, as we're in the red a little bit with them. But yeah, great stock, yielding at 5%, I believe. So yeah, into AbbVie we went as well. Then over to the UK, we increased our position in Legal & General, a solid insurance company over here in the UK, currently paying a massive 9% dividend yield. They was able to maintain their yield as well through the pandemic and have a solid dividend history. A stock that we've increased our stake in, and over the next week, once again, we'll be averaging this one down a bit more. We can see here over the last 3 months that the share price of Legal & General has taken a little bit of a beating over through COVID-19, as it had an effect on their share price. But I still think that there's quite a lot of upside with this company. So yeah, sticking it out obviously. Next we go over to Ferrexpo, a FTSE 250 stock, which I believe is undervalued. They've got good growth and financials. If you take a look through the company, and pay a good yield at the moment of 5%. Once again, we held a position here already, so it's just a matter of trying to average this one down, get a better cost basis. They've got a very low PE ratio, and yeah, if you've got time, guys, check them out. Then over to Shell. So we bought a small amount of Shell as it's dropped down to £9 a share, which I believe is really good value for Shell. I'm not a fan of the big oil companies, more believe in the renewable side of everything going forward, but Shell are transitioning, so out of all of them I think that they'll be able to transition a little bit more smoothly over, and they're doing the right things by the looks of it, moving in the right direction. So at £9, definitely is still, I believe, a reduce their dividend, but still above average dividend. So whilst they're at this price, we're going to add some more of Shell. Not a priority, but whilst they're at this price, I'll average my cost down. Then we have the newcomer to the portfolio, who are Trig. So This is a UK company. I've been looking at them for quite a while, to be honest. They're focused on renewable energy projects. They've been doing really well. Financials look good, pay a good yield, around 5% or so. I believe this company will grow and have a promising future, take a place up in the portfolio. And then what we've done is take an opportunity to get our average down with Lloyds Bank, in the red with Lloyds by about 16%. So as they've dropped down, great opportunity to get our average down with them. And they've cut their dividend, but I believe it'll be coming back in the near future, and we'll also be paying out dividends quarterly, which is a bonus. Most UK companies don't. So yeah, it's going to be a big player, I think, in the future, and the return once everything gets a bit more stabilized. So we'll get our average down, not going to go crazy on the stock, but just try and get our cost basis in a better position than what it's at the moment. As you can see, this week we've gone a little bit more heavy on the higher dividend paying companies. I wouldn't advise to just go chasing the yield. That's not what we're doing here, or that I would advise for you guys to do or to look out for. There's always space for these lower yielding companies in the portfolio, as long as they've got a decent growth rate, which a lot of the ones in the portfolio do. So like Visa, for example, Starbucks, they've got really good growth rates, and over the period of maybe, let's say 13 to 15 years onwards, if they was to maintain that kind of growth rate, they would overcome a lot of these higher dividend paying stocks. So there's always a place for them in the portfolio. If you're working with a time frame of like 20, 25 years or 30 years or so, then definitely look at the stocks that do have a good growth rate, and you don't need to be that concerned, I would say, with the actual yield, unless your time frame is less than that, on 10 years or over that side of things. So we're going to leave it there today, guys. Thanks for tuning in. Please like, comment and subscribe. If you want a free share with Trading 212, check out the description and you'll find a link there. If you're on Instagram, add me on Instagram and Twitter, and I will see you probably next week.